Hello, everyone, and welcome to our Fundless Sponsors in the Middle Market webinar. We will begin shortly as we wait for a few more to join us. Hello and welcome, everyone. Thank you for joining us for the webinar today. My name is Kristen Spiegel, and I manage events here at Axial Market. We are thrilled to be hosting this webinar today in collaboration with Merit Capital Partners and Fulton Capital. Before we begin the presentation, I would like to give a quick overview of Axial Market and an introduction of our presenters. After the presentation, which should last about 30 minutes, we will open the floor to questions. Please feel free to send us any questions that arise during the course of the webinar via your chat box, and we will get to as many as we can within our allotted time. For those of you not familiar with Axial Market, we are a network of over 9,000 accredited and active field professionals. We help connect all types of private market participants around live and relevant transactions. Examples of our members include investment banks, private equity firms, lenders, corporate development officers, fundless sponsors, and high net worth individuals. Our goal is to facilitate new relationship building, more easily manage existing relationships, and ultimately close more deals faster. The marketing organization here at Axial Market focuses on providing relevant and informative content to investment and deal professionals in the private capital market space. We do this through hosting events, webinars such as these, and regularly publishing reports and articles on our blog. We are looking forward to a very robust pipeline of events in 2013. For today's webinar on Fundless Sponsors in the Middle Market, we are happy to have Axial Market members Evan Gallatin of Merit Capital Partners, as well as David Schlossberg and Phil Kerber of Fulton Capital. With that, I will turn the floor over to Evan, Dave, and Phil, and as mentioned before, please feel free to send your questions to us throughout the presentation.
Thank you, Kristen. Appreciate the introduction and the opportunity to participate. I want to first start out, I'm here with David Schlossberg and Philip Gerber of Fulton Capital, and they'll give a brief introduction of Fulton in a second. Let me first start, just give everyone a little bit of background on Merit Capital. Merit is a Chicago-based mezzanine and equity investor. We are currently investing our fifth fund of approximately $600 million. We invest in transactions with enterprise values between $25 million and $100 million. Since the early 90s, we've been investing for about 20 years now. We have supported independent sponsors. Approximately one-third of our deals have been with groups such as Philip and David's here, and two-thirds of our deals, on a side note, are with existing owners doing a minority and majority recaps. A key part of our strategy has always been looking for a partner to work with, whether it's the existing owner, an independent sponsor, or an outside consultant, somebody who's involved with a deal that has a meaningful equity stake in the company, that's more likely to drive value than we are. We are really board level, active at a board level. We are involved more on a monthly and quarterly basis, and we expect to have a partner who's got an equity incentive that's more involved on either a day-to-day or certainly a weekly basis. And that's been one of our main drivers for working with independent sponsors. Over the last 8 years, Merit has hosted a conference specifically focused on independent sponsors. The event allows independent sponsors to connect with each other, talk about best practices, and also obviously gives Merit a chance to stay in touch with the independent sponsor community. One of the key items that came up just a few years ago was, as we were marketing it as a Fundless sponsor conference, was a request from our participants to change the name to independent sponsors. And this was something that we agreed on, because the reality was a lot of these groups are not exactly fundless. They bring capital to the table, and independent is a better way to describe them. Obviously, we will spend some more time talking about this in the presentation today. But first, I'd like Philip Gerber to provide a background on Fulton.
Sure, thanks, Evan. Fulton Capital was founded by David and myself approximately 10 years ago. Since that time, we've completed as an independent sponsor 4 platform investments, and we have a particular focus on distribution deals. We focus on companies with sales of approximately $10 million to $100 million and EBITDA about 2 to 10. Out of our last 4 platform investments, the most recent 2, we actually partnered with Merit Capital on. We'll discuss those later on. As opposed to a traditional PE firm, and maybe even as opposed to some other fundless sponsors, our goal is really to hold 3 to 4 companies at a time because we get very operationally involved in our businesses. So we could take as a role, we're either anywhere between a very active day-to-day interim CEO, if the situation requires it, or we could be a very active board member focused more on strategy, M&A, as opposed to day-to-day operations. So we have a lot of flexibility in our structure, but really focused on our a handful or 3 to 4 portfolio companies at a time. And with that probably transitions nicely in terms of the role into Evan's next slide.
This slide is, there's nothing scientific about it. This is just how, one way that Merit views the independent sponsor world. No one's exactly fits perfectly into any one category, but these are kind of 3 different segments within independent sponsors. The first is the most basic role, which is really kind of what we call an agency role. And this is groups of independent sponsors who are out just finding deals. And that's always a good place to start, because as PE investors, we like to invest in deals, and we like to have extra deal sources out there finding transactions for us. Now the folks who play in this role, there tends to be some very good ones who are working the networks very well and finding some proprietary opportunities or unique opportunities, and there are others who are working the basic intermediary networks and bringing us maybe a little bit more marketed deals. The truth is, any of those are fine. Now, you step up to the middle, more the sponsor role. These are the groups that we tend to like a little bit more, because what they're doing is they're not only bringing you a deal, they're also bringing some post-closing value. They're staying very active with the management team. In the case of the deal that we'll talk about later today, that Fulton we worked on together at Cobra. This is a situation in which Philip and David here were very close with management. They talked to them on a daily or weekly basis, where Merit didn't. We were allowed to kind of focus on other transactions, other dealings, and we always knew that Philip and David, they proved early on during the diligence process that we could be very comfortable allowing them to maintain that relationship with the company. And then there's all the way to the far right, the industry and operating expert. Obviously, this is sort of the best of all worlds. These are people who are not only bringing you an opportunity, they're staying on and working with the company post-closing, but they also have industry connections and maybe are driving new business, things of that nature. So that is obviously harder to come by, harder to find those opportunities. We have closed a couple deals in our fund in which we have teamed up with guys who are in industry. They found an opportunity within their job that they allowed us to partner with them and make the acquisition, and then they stayed very involved post-transaction. and those are certainly the cream of the crop opportunities that we come across. Now, for us, once we've closed deals with guys who are in the agency roles or the sponsor roles, as well as the industry operating expert roles. All of those are fine. The key thing, I think, to understand up front is really know who you are, know which one of those you fit in, and market towards that. I think the only issues we've run into is when perhaps an independent sponsor is suggesting they're a sponsor role and really they want to play the agency role, which there's nothing wrong with it. Once again, the agency role person tends to want to build a portfolio of a lot of deals and spread their time around. The sponsor role is a lot more time committed to just a few deals, and then shifting all the way to the far right, the industry operating expert is really focused on maybe just one or two deals at a time. Once again, any of those are fine, but this is just how we look at the different categories. So why do advisors include independent sponsors in their process, and why should they? Well, the first reason is really simple math. Most advisors do not have a dedicated professional who's out talking to PE firms on a daily basis. They're usually smaller shops and maybe 2 to 5 people in their shop, and they just don't have time to build up that network. They're dealing with getting clients, helping the clients prepare documents, finding the buyers that they can, and many other administrative tasks. The PE world is trending more towards specialization, with PE firms focused on certain EBITDA sizes or specific industries or specific type of deals. Maybe they're debt only, maybe they're debt and equity. It is much more difficult for advisors to know the best groups to go to on each one of their deals because usually their deals are unique. So the independent sponsor plays a critical role for them because the independent sponsor usually is not limited by criteria like a traditional private equity firm would be. They may be investing their own money, or maybe they have built a network of investors in different categories. So when the advisor is talking to these independent sponsors, although they're just making one phone call or one email, they're really reaching out to groups that have networks of people that may be perfect fits for any of their transactions that they're working on. I know when Merit talks to certainly on the advisors on the smaller side, there may only be one deal a year, maybe one deal every couple of years that are a great fit with Merit. So it's not easy for that advisor to find the right buyer at all times, where an independent sponsor can really expand their network. But there are other factors to consider as well for the advisor. There's what I've dubbed the hustle factor that the independent sponsor brings to a deal. Traditional PE funds have management fees, while independent sponsors earn a living by closing deals. So these independent sponsors are much more motivated to get a deal done, which aligns them well with the advisor who only gets paid when a deal closes as well. Further, since they have no management fees, they have to pay their dead deal fees on their own. So when advisors are seeing independent sponsors spending dollars, that gives them some comfort that they're serious about getting a deal done. Also, this makes independent sponsors willing to work harder to solve problems and get deals done. Of course, some of these factors do cause some concerns for funded PE, from a funded PE perspective, which we'll address later in the presentation. An additional factor for the advisor is that when an independent sponsor is involved with a deal, you know who you're dealing with. You're dealing with the decision maker. Usually these firms like Fulton Capital here, we have David and Phillips. These guys represent all of Fulton. There's no surprises. There's no one, no boardroom that they have to go to and convince a different group to make the investment. They can make the decision on their own, especially when they're dealing with their own capital on deal sizes that make sense for them. It is sometimes unclear when advisors are dealing with traditional PE firms exactly who's making the decision. The simple math really works both ways. On the advisory side, those are small groups, and on the traditional PE side, most funds have 5 to 15 professionals. And at any given point in time, those professionals are involved in a new deal or involved in dealing with a portfolio issue or perhaps involved in fundraising. Therefore, there's only a handful of us at a given point in time that are actively out in the market looking for opportunities. So it's obvious that we would want to expand our deal network by talking to independent sponsors. And particularly from Merit's point of view, we don't only work with independent sponsors because they bring us deals, as we talked about earlier with the agency model, although that's nice. We certainly look for a little bit more than just that. We're looking for groups that are active post-deal. More eyes watching is always better. Obviously allows us to focus on the other deals we have in our office. Also, as we did with Fulton, and we'll talk about that again with Cobra later in the presentation, we had an acquisition strategy. And as opposed to taking management time away or taking Merit's time away, that was one area that we leveraged Fulton's time, and they went out and looked at acquisitions and focused on that. In general, in dealing in the middle market, you have small, thin management teams. They need a little more help on the financial side. They may need more help on the strategy side in different areas. And this is where we also look to our independent sponsor partner to really take that lead and work closely with them. Now, the reality is this model, independent sponsors working with PE, isn't a fit for everyone. There are some PE firms and who have been very successful who take a very active role in being a sponsor and working closer with their company. That's not what Merit has done traditionally. We've done that directly with management teams, but we've also been able to get comfortable with independent sponsors taking the lead. And that's not always easy for a PE firm to be able to take a step back and feel comfortable that their partners are watching the company appropriately. And that's why it's a very selective process Merit goes through to determine which independent sponsors we're willing to partner with and look at deals with. And the most important part is that the communication is clear. As I mentioned earlier, we have done deals where the independent sponsor agrees that they're not going to play that sponsor role. And that's okay. But if they say they want to take on the sponsor role, we think it's important to make that clear up front and so we know what roles people are taking. So something that's near and dear to all of independent hearts is, what are the economics? What is in it for them and these groups? And as we'll get into here, every deal is different, so it's very hard. But as you see on the screen, I've laid out a couple of things that are worth discussing. I mean, certainly the first one is purchase price. That is a major driver of the economics for independent sponsors. If an independent sponsor is bringing a deal that's been marketed by a very well-established investment bank and it was sent out to 300 people and they've cleared the market, it's obviously very difficult to provide very favorable economics. The next one is, what time commitment are the independent sponsors going to provide here? And this goes back to what we discussed earlier, what role they're taking on. Time commitment is very important to Merit. We like to have sponsors, once again, in an ideal situation, who are going to roll up their sleeves and get involved on a maybe not a daily, but certainly a weekly basis. It also comes down to when deals are presented. Historically, since we've been working with groups like this for the last 20 years, deals were presented to us at the LOI stage. So went through the process. You knew what the purchase price was. You knew what the deal was. We got involved with 60 days or 75 days to close the deal, and that brought a lot of value to us because a big part of the uncertainty was taken away. As the independent sponsor market has become, I want to say, more prevalent, we are starting to see deals at a much earlier stage. We're seeing deals pre-IOI. and certainly pre-LOI, which is okay. Sometimes that's just necessary to bring us in and help establish when these independent sponsors need outside capital to help establish that the capital is there. It's less value to us, just from an economic standpoint. We obviously have to do a lot more work to get it to an LOI and certainly get it to close. Not an issue, just a driver of economic value. The fourth point is the ability to bring or invest equity. Now, this really is across the board for us. We deal with groups who write several $1 million of checks to groups who really are bringing sweat equity. While we're indifferent when you talk about economics and things of that nature, it is important to us, and it helps the independent sponsor if they do have a source of capital, whether it's their own money, their family money, their friends' money, whatever they're able to bring. It brings some credibility that we're not the only investor who supports them, that there's other groups out there that support them and makes us feel better about their ability. And once again, just drives better economics for independent sponsors. Because not only can they earn money on our deal, but they can also earn money on the capital that they're bringing to the table. 5 is an easy one. It's the value-added, industry experience. What tends to be the most difficult in that is finding the right person. There are very niche industries that we're focused on, and sometimes it's difficult to find that right operating partner or executive to bring in. But when they do find the right person who can really drive value post-close, that's something that we're going to compensate them for. Number 6 is, yes, purchase price again, because as much as some of these other factors mean a lot, it really does come down to purchase price as the main driver, as you'll see on this next chart. There are typically 4 areas that we discuss that are up for discussion anytime an independent sponsor calls us up and wants to talk about economics. Once again, very deal specific. Very hard to even put any numbers down in a general phase, because a 3 times deal versus a 7 times deal has a dramatic impact on what we're able to offer. So the first item is transaction fees. And this is, once again, something that's different for each independent sponsor. It just depends what type of group they are, what type of capital they have behind them. If it's important to them, we are happy to provide some type of transaction fee, but it is, once again, very driven on purchase price. If we're closing a deal that we feel is at the top of the market, there's just not as much room. If we're closing a deal that we feel is at a good value because the independent sponsor brought something, yeah, there's certainly more room to share. Certainly the bigger independent sponsors are bringing capital to the table and really don't necessarily ask for a transaction fee or require one, and that helps when you start talking about the other categories. The second area, the promote, the free equity, similar issues related to the purchase price. If you're at the top of the market, it's really hard to say, not only were you won the top of the market, but now Merit, we're going to give up 5 or 10% of the economics, because then we've only not only we topped the market, but now we're paying on top of that. That becomes difficult. So we have to be convinced that this deal is being brought to us at a below market or slightly below market value, or the sponsors bring so much value to the transaction. Maybe it's because of capital, maybe it's because of experience, that we can provide them with promote or free equity. The management fee really falls out of the agency category, more to the sponsor and the industry operating partner category. This is something where the independent sponsor is going to provide, a meaningful time commitment. It's going to be clear that they're not going to be on 8 different boards, involved with lots of different companies, that they're going to be focused on 2 or 3 companies. And certainly their industry experience and their background drives what the management fee will be for them. Incentive equity. this is also related to what are you doing for us post-close. Once again, our hope is always that the independent sponsor is someone who can bring value, and we'd love to share more equity with them, certainly on successful deals. Once again, these are groups that we feel will be very influential in creating equity value, and we're happy to share. And sometimes there are deals, once again, where it's a very nice company, you are paying market value, and we can't give you as much up front, so there's more focus on the back end. So that does happen with agency people who are not necessarily going to be involved with the deal, but do bring a nice deal where we feel like we can't compensate them up front, but we do want to, compensate them appropriately, and there's a way to do it on the back end. So how do you drive to higher values, higher economics? How do independent sponsors get higher economics? I mean, it's, what we talked about earlier is obviously bringing low purchase price deals, bringing a deal under LOI, having some industry operating partners, and perhaps bringing some capital to the table. But there's other factors, too, that do come into play. And we did talk about time and focus, not just a portfolio of many different deals, but it's also building that working relationship with management. We think that's important. Important that the independent sponsor is on the same page as the management team, everyone's comfortable in their roles. The independent sponsor has a good enough relationship where they can kind of figure out problems before they occur. And we're watching them build this relationship during the diligence phase. Selfishly from Merrick's point of view, it also allows us to focus on other issues and leverage the time of the independent sponsors. A lot of groups we are working for the first time on. There's groups, if you look at the deals, and we'll show some slides at the end of the year, you'll see there's independent sponsors which we've done multiple deals with, like Fulton, because we get comfortable with how they operate. But there is a lot of times we are just learning and meeting this group at diligence. And I think what's important is watching these groups and their judgment at diligence. When issues come up, because issues always do come up, how do they attack these issues? Are they coming up with solutions? Or are they just saying, we can live with it and let's get on with it? There are some groups that really roll up their sleeves and prove in diligence that they're just not going to let anything slide. And that gives us more comfort post-closing that they're going to be there for us. And once again, we can spend time on other issues and other deals and feel very comfortable that we have a group that's focused on the important points. And then the last one is know when to walk away. There's just sometimes the deal just doesn't make sense. You're going to run into an issue, and it's painful. It's painful for us. It's painful for the independent sponsors. We spend a lot of our time trying to get these deals done, and obviously, we're sitting as a fund with management fees. Independent sponsors aren't. But there's a time, and there's a lot of credibility. There's always another deal out there. Know when to say when. And that does impact how we think of economics the next time around. It builds up that credibility. I'm going to turn this over to Philip now to talk about our experience on COBRA. So Philip, why don't you take it away?
Sure. Thanks, Evan. So for COBRA, we'll break it up into two sides, really the pre-closing and the transaction diligence aspect of COBRA and our role. In the next slide, we'll discuss the post-closing role we played at COBRA during our holding period. But COBRA Wire and Cable is a distributor of proprietary high-end wire and cable and related products. The situation was that COBRA was being sold by the initial founder and owner-operator by an investment bank. During the transaction process, it came to light, to everyone's surprise, that there were some due diligence issues and large risk factors with respect to certain aspects of the historical operations of the business. The traditional private equity firms kind of ran to the hills. David and I were fortunate enough at that point to take a step back, really roll up our sleeves. We had a great relationship already with management and gotten in with them And we really started diligencing it and trying to figure out, whether this was a diligence, pricing or structuring issue that we could somehow close on and over, or whether it was purely a walkaway issue like everyone else's knee-jerk reaction. Through some diligence, we got comfortable that it was our thought that it was a diligence and pricing and structuring issue. So we entered into a letter of intent with the business, with the company to acquire the business. When we entered into LOI, we went really looking for a financing partner, and we were fortunate to find Merit right away. And what we were looking for, from Fulton's perspective, being an independent sponsor, was a variety of things with the partner. Obviously, we were looking for capital to close on with the transaction because it was a large transaction for us. We were also looking for some private equity expertise that Merit Capital had, and also we wanted someone with substantial experience dealing with independent sponsors. We wanted someone, during the pre-closing and transaction process and post-closing process as well, we could all work together, not step on each other's toes, interact with the banker, the company, the management team, and each other in really a cohesive way, and we all defined our roles in the diligence and post-closing aspect, and made it for a very easy and compelling story for the management team once we brought Merit into the transaction. So at the end of the day, we were able to diligence the issue, structure and price around it, bring in a great partner with Merit, and we closed the deal. On the sell side, we had a very happy investment banker who was, I think, very close to having a busted or failed process. We had a very happy seller who exited from his company and his life's work. The management team was happy to be, in new ownership and have an opportunity to grow. And Fulton and Merit was happy that we had a great transaction, a great company, that we were able to resolve the diligence issues and really, continue the business on a post-closing basis under new ownership. Which transitions to the next slide in terms of our role post-closing. As Evan mentioned, there's different aspects for each independent sponsor. So this relates to the post-closing operations. Cobra, when we closed on it, really had a great 3-person management team in the business. The CEO, who was the owner, retired at closing, and we really parachuted in as Fulton to really work with and guide that 3-person team. We were very active for the first 2 or 3 years post-closing. I call it an active chairman or maybe even active CEO role on an interim basis. For 2 to 3 years, we were on the ground on a regular basis, weekly in Philadelphia, probably anywhere from 2 to 4 days a week, making sure we were there. When we weren't there, we were still working on the deal on the operations or acquisition side. But we were very excited about the opportunity and really working on a day-to-day basis with the management team post-closing to help groom them and help grow the business. After about 2 or 3 years, in the deal, we remained very active, but we decided we needed to bring a CEO on board to really bring the business, take it to its next level. We commenced a search for CEO. We're very fortunate. We found a great CEO through an extensive search process, brought him on board. Merit and Fulton worked together in that search. We integrated the CEO, into Cobra Wire. And, our role changed a little bit, so we were no longer day-to-day, but our level of involvement did not change. We basically started to work a lot more extensively on the acquisition side. We worked with the CEO a lot on the strategy side, and we still remained involved with the management team, but at the same time very conscious that, certain things need to be reported to the CEO, so we really worked with him to define everyone's role on a going-forward basis. So, very actively involved both pre-CEO and post-CEO. Last year, we were fortunate enough to exit, have a very successful exit from the business. We sold the company, which was a great transaction, really all around. It was great for Fulton and Merit. It was great for the management team. They're still running the business and very happy with the new employer. And it was great for the buyer. The business is still doing quite well and still rolling along, growing very, very nicely. So the takeaway from our perspective, or related to the slides, is we were very actively involved our goal as Fulton is to be very actively involved in our companies, and we were active pre-closing on the diligence and solving problems, and post-closing on an operational as well as an M&A basis. I will now turn over to David, and he can give you an example of our next transaction, which was Econolite, which was also done with Merit Capital, and how we worked with Merit on that deal.
Okay, thanks, Philip. So Econolite was the second transaction that we've done with Merit. That was a pretty unique situation where Merit actually brought that transaction to us. It was, in the middle of the Cobra transaction, so we had developed a nice working relationship with them. Econolite was a situation where Merit, through a previous investment, had a relationship with a lighting manufacturer who had a separate, wasn't even a division, it was a brand that imported commercial and industrial lighting from Asia and marketed it through catalogs and the internet. And that lighting manufacturer approached Merit looking to spin out that brand in order to help them raise capital to focus on LED lighting, which is the new thing in the lighting industry. Because it was just a brand and not a division, they didn't have any dedicated employees, they didn't have any dedicated infrastructure, they didn't have any dedicated financial statements, so it was a pretty complicated transaction to get done, which is why Merit approached us to help them do it. The first thing we needed to do was really roll up our sleeves and determine whether or not there was a transaction there at all, whether or not this brand could be separated into a viable company, and if so, how were we going to go about doing that? So we spent, it was a long diligence process. I forgot how many months, but working with Merit and the company and the accountants and really trying to figure out what is the profitability of this brand, and trying to come up with a plan to actually separate it and then eventually create a standalone company. So when we bought the company, the parent company continued to run it for us because it didn't have any separate employees. But none of the people who were running it were dedicated to this brand, dedicated to Econolite. So Philip and I had to get very involved with the team that was running it, because although they were all very good, competent employees, Econolite needed people to be focused solely on Econolite, and that's really where Philip and I came in. So we acted as the CFO, whereas there were accountants preparing, financial statements. No one was really analyzing those financial statements. No one was looking at management reports. Just kind of the basic blocking and tackling things that if you had a dedicated management team, they would be looking at, where you're spending your money, the success of your marketing programs, things like that. Those are the roles that we took on working with the team that they had in place. Eventually, our plan was to separate the business. So after we were in there for 6 months or so, when we really felt that we understood the business and what was needed, we started a separation plan, which involved, basically looking for a new CEO and a whole new management team, looking for a physical space, building out a warehouse, and really everything that you would need to do to start a business. As it turned out, after we were in there for a year or so, there were some larger transactions that were happening in the lighting industry. The parent company that we bought the brand from was being purchased by a large public company, and as part of that transaction, they wanted Econolite back in the fold. So it was a relatively short hold for us because we agreed to ultimately sell it, probably a year and a few months. And it turned out, again, to be a very nice transaction for all of us, but, a very unique one, and where we were able to, really get on and work closely with the team in place in order to make it a, successful transaction for everyone.
And I cannot overstate, how important Fulton was on both Cobra and Econolite. The amount of time and dedication they put into those transactions was key to having successful outcomes in both cases. So in conclusion, as we discussed throughout the call today, independent sponsors play an important role in this market. And they will help brokers and advisors expand their network. They help bring deal flow to private equity groups and post-deal value. And I think this is a group that we will continue to see thriving within the private equity industry. We'll flip through a couple slides that shows some of the deals we've closed with independent sponsors. Happy to talk about any questions you have. I believe that Axial will now open up the line for some questions.
Yes, thank you. We do have quite a few questions from our audience today. We'll start with our first question from Lane. He asks, what are some common arrangements put in place to protect an independent sponsor from the investor ultimately going around them and excluding them from the transaction?
You know, from Merit's standpoint, we have a reputation in this industry of working with independent sponsors, and it's just very important to us that, you know, we maintain that relationship. We would not try to go around independent sponsors. A lot of times they are asking us to sign certain language that precludes us from doing that. What we have and been willing to sign is we're certainly not going to go and call the owner or call the investment banker and look for the deal in any situation. If a group comes to us with an opportunity, we are going to work with them. And this does change a little bit when you talk about IOIs versus LOIs. Certainly, it is more difficult when we see deals at a very early stage. But what we do is we promise that group that we're not going to go actively try to work around them. If someone comes to us, just like they can go to any other group, you know, we'll certainly listen and be open to a conversation. But typically, we try to find an independent sponsor group that we're going to work with exclusively, and we work with them on that basis. I don't know if Fulton has any experience with that.
Yeah, I'll say that there have been times where we have asked for some type of non-circumvent or exclusivity. Probably more times than not when we know the group and are comfortable with them. We won't do that just because we're comfortable. Certainly if we talk to Evan about a transaction and he may have seen it already, or he may be already working with another fundless sponsor on it, then he'll tell us. But if that's not the case, we're not worried that he's going to go around our back. And that would be the case with other groups that we've worked with. I think if groups were to do that, it would probably get out there pretty quickly. But that said, there have been a few times when we've asked for it, and as far as I can recall, it's never been a problem getting someone to sign something.
Great. The next question surrounds the idea of executive in residence. How does this model differ from or fit with an executive in residence?
If I understand the question, it's my understanding executive in residence will be focused primarily on one transaction and putting himself or herself into the deal. So some private equity firms have a stable of CEOs that they look to parachute into deals and run those businesses. Our model differs slightly at Fulton Capital in the sense that we want 3 or 4 companies at a time. So depending on where a company is in its life cycle, or where we are in the transaction cycle, David and myself will ideally have one company maybe that we're on a very active basis, almost interim CEO, and another company that we're each on a very active basis, kind of board of director, board of advisors. We're both on the board of all of our companies, but one of us take a lead per company. So we're looking for a small portfolio of 3 or 4, as opposed to just one. That's my understanding of the executive in residence. It's more of a one person looking to operate that business on behalf of the private equity firm. We've seen, at our prior positions or prior jobs that had very active portfolio managers, which might be a hybrid of executive and residence, but those guys will go around and won't be as active as we are, or independent sponsors are in the transaction.
The next question surrounds the idea of due diligence. How much due diligence does Merit do on a deal? And how do you deal with an owner or seller who may not wish to have 2 parties doing active due diligence?
That's a good question. A lot of this, once again, comes down to the timing of when we get involved. For the most part, we're getting involved at the LOI stage or before the LOI stage. And then we're working closely with our independent sponsor on determining how are we going to attack diligence. Because this is an area that Merit does take a very active role in. And we do it for several reasons. One is we want to certainly get comfortable with the management team and the transaction, the company itself. But we also want to be working very closely with the independent sponsor and see how they're working. Independent sponsor watching this investment closely. So it's just very much about a coordination and a plan up front as to who's conquering what diligence, and just an agreement of how that's going to work. Philip?
Yeah, and I would echo that. I think that's one reason why it's so critical for an independent sponsor to really pick the right partner. So I think I broke it out when I was talking about, that you want capital, you want private equity expertise, and you want someone familiar with the independent sponsor market. I mean, we've had a great relationship with Merit, and they've been a great partner. We don't expect a partner to be silent during diligence, so we don't want that. We want brainstorming, we want additional eyes and thoughts, but we do make a lot of effort, and Merit is very comfortable with it in coordinating our effort. The last thing you want as an independent sponsor is to scare the investment banker or business broker, or scare the owner or the management team, in the sense that you have too many people coming at the company in a disorganized manner, and then they're not communicating, or that neither of them is the ultimate decision maker. So we make a lot of effort to coordinate our due diligence process. There are multiple eyes looking at it, but we go in as a team, Fulton/Merit, as opposed to going independently. And by coordinating and really by working with someone who's familiar with independent sponsors and their role, like a Merit Capital who's done it before, it makes it much easier. And from our perspective, really the only way to do a good transaction, because you need someone to understand the different roles and different diligence processes, because we don't expect people to take a back seat on the diligence side, and we want their input.
The next question is specifically for Fulton. How do you source your deals?
We source our deals probably from the same way that most other people are out there are sourcing it. Obviously we're going through traditional routes of the business brokers and the investment bankers and the attorneys and the accountants, and certainly in terms of volume, we're seeing most of the deal flow from them. But we're also trying to find the proprietary deals, I imagine, like everyone else is. Unfortunately, those are fewer and further between. Of the 4 platforms we've done, I'd say 2 have been directly sourced. One directly sourced by us, the other one was kind of like directly sourced by Merit, and the other 2 were with an intermediary.
Yeah, and all I would add to that is that when we do go direct, it's more typical for us if it's an industry we've been in. So we'll make some calls within the wire and cable. We're very aggressive looking for opportunities in that industry now, either on brokers or direct. And we're also very aggressive in the light industry, looking for new opportunities from brokers or else direct. But when we have experience in the industry, we obviously have a calling list of guys we've looked at, and then we go directly. But otherwise, we're very active in the broker side, investment banker side, looking for transactions.
And of course, getting great deal flow from Axial Markets, right?
100%.
Our next question is, what is the typical range of transaction fees, and separately, the general percent equity for independent sponsors running the company post-close?
That's just such a hard question to answer because it is so specific on all the items we talked about today. I think what's important is when an independent sponsor brings us a deal and says, this is what we're asking for in the transaction, it certainly begins as a conversation. You really have to look at the circumstance and say, is it, does it make sense? Is there room for this transaction fee or for a sponsor like ourselves to give up some equity? Because are you arguing that you're getting a good deal, or you're bringing extra value that is going to drive a better deal for the sponsor? So I'd love to talk to anyone offline about a specific situation, which I'm always happy to do, and we can kind of give you quick feedback, but it's just so specific to that deal when you talk about customer concentration and management involvement and all these different factors that drive economics for independent sponsors. It's just unfortunately, it's just too hard to talk about in general.
Our next question deals with broken deal fees. How are they handled, and who assumes responsibility?
From our perspective, we understand that Merit has a fund, and we're getting management fees, and a lot of the independent sponsors groups that we're dealing with do not. This is where we talked about earlier with the coordination of due diligence. While we're happy to be open to the independent sponsor choosing who that diligence partner is, when we talk about debt deal fees, it is a lot easier for us to go to the groups we work with, because in circumstances like this, or circumstances where a deal does not get done and there are debt deal fees, it obviously is easier for us to negotiate, to take on that fee ourselves, and we'll deal with the negotiations with those parties, because we'll know we'll have other deals to give them. For the most part, what we've done with independent sponsors, generally speaking, is, hey, we'll cover kind of all the diligence fees, where they're covering really their own legal fees to the extent that they have specific legal fees, and maybe their own travel. But any of the really big expenses where we're hiring a third party typically falls on Merit. Once again, as long as that's coordinated and discussed, which we really haven't had a situation in which that hasn't been coordinated or discussed. So I think that was pretty typical. I don't know if Fulton has a difference that the PE sponsor would pick that up. I guess some folks may be harder to negotiate with than Merit is, but let me know your experience.
Yeah, we're all in favor of that as well. At Fulton, we've definitely in the past been burned by debt deal fees. And for us, that goes into the consideration of what point do we bring a deal to an equity group, a funded equity group. If we bring it, what are the, obviously if we bring it to them early on, we may be giving up some economics if it's pre-LOI stage, but perhaps the trade-off is, well, then they'll get involved earlier on and they'll be picking up debt deal fees. So it's certainly not something that's going to, at the end of the day, probably not the most important issue out there for us, but we are very cognizant of the fact that when we go into a deal, we don't want to be on the hook for hundreds of thousands of dollars of debt deal fees.
We have a follow-up question to broken deals. How do you get comfortable that the PE firm walked away for the reasons that the broker suggested versus another reason that you needed to discover on your own?
I don't know if that's just a general question on any deal. If you're saying we are now getting involved, it sounds like the question is we are now getting involved with a deal that was already a broken process, and how do we get comfortable with that? I'm not sure this is necessarily specific to independent sponsors, and I apologize if I've answered the question incorrectly. But that's just something you're always weary of in any deal when a group is in there and spends some time, and they spent money on diligence as to why would they walk away, and you just have to get comfortable with the facts on your own and roll up your sleeves and figure out what the problem is. I think as our experience with Philip and David are on Cobra, the PE firms who walked away, in our opinion, after Philip and David rolled up their sleeves, spent months and months trying to figure out the issue in that case, we believe that the other PE firms jumped out a little bit early, and in the end, there was a very logical solution to the problem that was presented, and kudos to Fulton for hanging in there.
Yeah, I think I would add it also depends a lot on your relationship with the broker or the investment banker. We work really hard on trying to have relationships with the broker and banker community. And obviously these are long-term relationships, so hopefully both sides can help each other. So frequently a broker will guide you to where the problems was, but certainly want to uncover them on our own as well, and work very hard to do so. But a good broker can get in there, a good banker get in there and help you resolve these diligence issues, because it's everyone's on the same page, or everyone wants a deal done at that point if it can be done. So the relationship with the broker or banker is also very helpful.
We have time for a couple more questions. The first one is, how should a true fundless sponsor answer concerns from investors about not having his skin in the game?
I'll start. From Merit's standpoint, listen, that is not the end-all, be-all factor. Once again, it's something that will drive value as far as the economics that they can receive. But it really depends on what their background is and what the reason why they don't have capital. And once again, capital is the definition of capital is really dependent. You know, we're looking a lot of times for a meaningful contribution, and meaningful may be a manager or an independent sponsor who puts up $50,000 or $75,000. It's meaningful to them. It's certainly not meaningful to the transaction, and certainly the sizes we're dealing with. But it says something about them. Everyone has different financial positions, and that's okay. It's just it's making that type of commitment that would get us comfortable with the situation. And really, that's just one small factor in the deal. I mean, we're looking at the deal on its merits, as a whole, and that's not an item that we necessarily walk away on, or that we give no economic benefit to the independent sponsor on. But it's a factor that goes in there. And I don't know if Philip and David have different experiences.
Yeah, I mean, in the deals we've done, we've invested various amounts to kind of, just prove that we've got skin in the game. For us, though, and I think probably a lot of Fundless sponsors say this, but I think it's true, the most important thing for us is our reputation. And we can't go out there trying to get deals done, which are going to be bad deals for the investors. Unlike funds where you can afford a couple strikeouts and maybe those will be offset by some home runs. We look at it, we cannot afford any strikeouts. Because the group that we have to strike out with, that may be our only deal with them. So we're not looking to make a lot of money from the closing fees. We're really looking to make our money from the equity and the incentive to promote that Evan talked about earlier. And I think that really gets all of our interests aligned.
And our final question is, how and at what point in the deal process does Fulton Capital select which private equity firm it's going to partner with on the deal?
It depends the transaction, the size of the deal. Candidly, if a deal fits Merit's requirements, we've had a phenomenal relationship with them. I say it even if Evan wasn't sitting here. So any deal that fits their criteria, we give to them. We have a great partnership. We're really focused on picking the right.
And I think that should be a rule for everybody on the call.
We focus on picking the right partners for a transaction. If the deal doesn't fit Merit, either because of the size or industry perspective, usually just from a pure size perspective, then we either fund it ourselves or partner with some other either smaller private equity firms or family offices, depending on the situation. But we're really focused on finding the right partner for the right transaction. And in terms of when you bring in someone, if it wasn't a fit for Merit, if it was a smaller deal, from our perspective, we really want to get in there and do diligence. I know a lot of guys say, bring it to us sooner rather than later, but we want to have a real live deal before we talk to someone, because in our experience, how someone responds to a deal is very different if they can kind of get a feel for pricing, transaction, structure, et cetera, because then they can say, okay, here are 3 diligence issues, but here's the price we're paying. Here's how our initial reaction is. We need to vet our reaction. We need to do some diligence on it, but here's our initial thoughts, and here's our initial analysis. We find that goes much better, especially if you're talking to someone new, than saying, here are the 20 issues I'm going to investigate if I can get a price range from A to B. I'm not saying that's the right way to do it, but that's, in our experience, has gotten us a better transaction, a better understanding of, what the right partner is. Because at that point, you might want to pick a partner that understands those particular issues. But for our larger deals and our transactions that fit Merit, again, we're partner focused and find the right deal, and I'd encourage everyone to do that as well.
Thank you. And as we draw to the close of our presentation, I would like to thank you all for joining us today. I hope that this webinar has been an informative look into the world of Fundless sponsors. A big thank you to Evan, Phil, and Dave for hosting the session. If you're interested in staying up to date on similar written content and events from Axial Market, including our upcoming webinar on identifying and mitigating risk in Latin America, please sign up for alerts on our events page, found at the URL shown on your screen. Have a great day and a happy holidays. Thanks.